let me start with you. Known for your very bull case scenario here, $7,000 a share on Tesla by 2024. What gets you to 7,000?
There are a number of variables that get us there. The first is our forecast for electric vehicles in 2024 is 34 million units, up from roughly 2 million last year. So that right there is an exponential growth rate. The second is our gross margin assumption. We are using Wright's Law, which you may have heard us discuss before. Wright's Law gets us from roughly 20% on auto margins in the fourth quarter to roughly 40% during the next 5 years. And then we're also looking at capital efficiency. Capital efficiency, we see now from Shanghai that Tesla can build a car for roughly $1,000 in capital spending per unit. That is one of the lowest rates out there. And finally, our belief that Tesla is furthest ahead in autonomous capability. So in that forecast, we have a 25% chance or probability that Tesla will launch an autonomous taxi network within the next 5 years. Yes, on average, on balance, yes. I'd just like to address the autonomous points that Edward made. So autonomous is an artificial intelligence project. Tesla is taking a leaf from Apple's book here. Apple was moving the smartphone market ahead so quickly, so much more quickly than Nokia, Ericsson, and Motorola, that it had to design its own chip. And the rest is history. Tesla is the only auto manufacturer to have designed its own AI chip. And our analyst, our AI analyst, James Wang, who spent 9 years at NVIDIA, took a look at the specs of that chip and said, Tesla is 4 years ahead of any other autonomous or auto manufacturer. The other way it's ahead is with data. The winner in an AI project has the most data and the highest quality data. Tesla has 14 billion plus miles of real-world driving data, while Waymo, the closest competitor in this regard, has 20 million, 14 billion, 20 million, and Tesla has 700,000 cars out on the roads. You could consider them robots collecting this data and sending it back every night. And they have the best AI team, we believe, not just in the auto industry, but maybe in almost any industry.
As the top manufacturer of electric cars, despite being expensive when compared to earnings, Tesla is still ahead of the competition in many areas. In the long run, though, I believe this is an undervalued investment since there are numerous opportunities for Tesla to create significant revenue between now and 2030. The Tesla Cybertruck is one of the primary reasons why the company's stock has soared since then. The Cybertruck is scheduled to begin production later this year. And then in 2024, it is expected to produce 375 units of Tesla's Hypertruck. With an average unit price of $60, that should generate approximately $22 in revenue in 2024 just from the Tesla Cybertruck, and the thing which is going Tesla way, it's the demand for Cybertruck. And if Tesla can double that in 2025, Tesla could make $50 billion close to a loan from Tesla Cybertruck in 2025. Just imagine that Tesla is poised to make $22 billion in revenue in 2024, just from the Cybertruck, and considering that in the fiscal year 2022, Tesla's revenue was $81 billion, that would provide a 25% increase in revenue just from Tesla Cybertruck next year. And this isn't a very futuristic projection, because we're just talking about how much Tesla can make from the Cybertruck in 2024. A 25% increase, now that should guarantee a 25% stock price. So I think that is one significant reason for you to buy Tesla stock today. And since the Cybertruck currently has a YouTube backlog of 1.9 million units, we're looking at 375,000 units being produced every year, at least for the next two or 3 years, even if we include massive cancellations that may or may not be coming up. Like I said before, what we are not short of right now is the demand for Tesla Cybertruck. Although Tesla is transitioning to a slower growth mode, the stock is still growing and is currently at a reasonable price. This, in my opinion, is what makes the stock more appealing, because it makes it much more affordable. If you buy the stock now and everything goes according to plan, The amount of return you could make by doing so is significantly higher than what it would have been if you had purchased it, say, a year ago. The stock is currently at a very reasonable price, and many businesses, including fully autonomous driving and possibly insurance growth, are heavily discounted. Additionally, future cost savings that management can still implement as it ramps up FAC battery and as it accused its 2020 Battery Day Goals 50 target. So there's still a lot of upside in the company at the current price. What's fascinating, though, is that yes, they did fall short of their own internal goals to generate growth of more than 50. We need more clarity, more realistic basic analysis, and future guidance from Tesla so that we can get our sights a little more realistically. I think that would definitely help management just to say that we expect to grow 50 year-over-year in deliveries over a multi-year period. They missed 50 growth in terms of deliveries last quarter, but 40 is still strong. Horizon does not really help with year-to-year guidance, especially as Tesla is now big enough to start seeing a demand impact from an economic slowdown. Now that they've noticed they're out 1.3 million vehicles annually, they're going to start to see some consumers who may want to hold off on that next big ticket item and then wait till the next year. So while we're in a slowdown, I think management guidance, more sort of confidence that can give us around specific targets and numbers from year-to-year basis, would certainly help the stock, because I think right now what the investors are searching for is the right growth rate with high growth stocks like Tesla. Even small changes in a growth rate assumptions can materially change your evaluation for the stock. Talk to us about incentives that will be having to be dangled in front of a US buyer. Is that a warrior? Is that a shining of a light on a fact that the price point is going to have to change? We do think there's going to be some small price cuts, as Tesla is going to want to make sure that many of its vehicles as possible, specifically some Model 3s and Model Ys, will ultimately qualify for the Inflation Reduction Tax Credit, and heading into an economic slowdown, we are in price reductions for that platform for next year in order to self-create demand growth, because I believe that will be a powerful way for Tesla to drive demand growth. This will help Tesla reach our forecasted delivery target of just over 1.6 million units in 2023. My point is that although Tesla stated a few years ago that they would be expecting a 50 growth rate annually over a period of years, this is a promise to make, and in reality frequently disappoints dreams. Not only that, but circumstances in the global economic downturn must also be taken into account. Taking all of this into account, I believe Tesla is still doing well. This is not how things work on Wall Street, where you make a promise, miss it, and then see your stock drop 20 following day. But is that the reality? Given the daily struggles, whether they occur on social media, on the air, or elsewhere, 40 is still a respectable growth rate. We or not, we should be looking at deliveries rather than the demand from your perspective. What is the main thing that we should focus our rise on now? When it comes to Tesla, is it China? Is it the deliveries? Is it the demand? Which side should you be looking for? I think there are two key things that we should continue to focus on. One is, as we go into 2023, what will be the growth rate? I still expect, you said double-digit growth rate. I'm forecasting 24 growth next year in deliveries. Then what do the profit metrics look like? If you remember back the first quarter, last year Z were achieved nearly a 30 gross margin in the automotive segment. And that was before the opening of the factories of Berlin and AOS as F. And as factories productions ramp up, I do expect the gross margins to go higher and the margins will improve sequentially. And so if that's a couple of days before Cathie would bought Tesla stock on the day of its biggest plunge, since September 2020, reaffirming her conviction in the electric vehicle maker, and that many other investors have gone into, and the funds backed by Soyuz firm ARK Investment Management bought more than 176,000 shares of the automaker in the first trading session of the year. According to ARK's daily data, the purchase came as the Tesla stock dropped 12 of the firm after the company missed projections for the quarterly deliveries, despite offering, according to Bloomberg's compilation of ARK trading data, Thefty Incentives Cathie Wood Exchange Traded Fund has purchased slightly more than 938,000 shares of the electric vehicle manufacturer since October 3rd. Following Tuesday's decline, Tesla is down 65 from last year as a result of various concerns, including inflation and rising interest rates. So that's it for today, people. I really appreciate you watching. If you haven't already, please subscribe. I also really appreciate you hitting the like button. I weigh the demand for electric vehicles